Investors, tax attorneys, CPAs. If one of those three rang a bell, listen to this interview. Hey everyone, Caleb Michelson here with At Homes Realty Group. I am sitting here with Kevin Jerry, the owner and CEO of TPTM. So Kevin, I'm diving right into it. Cost segregation. What is it?
Yeah, thanks. Thanks, Caleb. First of all, thanks for having me. Cost segregation has been around for about 25 years, and what it does, I'm going to take a step back. And what it does is it changes the way that your client, that a building owner or investor can depreciate his property, and not the property he lives in, but any property that he owns besides his primary residence. But I want to step back and talk about depreciation because it's really kind of confusing. Some people have heard of it and they think they know what it is, but they don't. So depreciation is one of the greatest tax laws that Congress has ever come up with. And what it is it's a way to take a tax deduction that correlates to the wear and tear of an asset and the diminishing value of an asset as wear and tear, occurs. Now, I'm not talking about depreciation like, you buy a $50,000 car and you drive it off the parking lot and it depreciates. Now it's worth $40,000. That's not what we're talking about. Depreciation is a tax deduction that you can take, and you have to take it. It's mandatory on any asset that you buy. However, it's not all it's cracked up to be. So let's say you have that $50,000 car and you buy it for your business. The IRS assigns a class life to that car. Okay, so they're saying a car will last 5 years. Now that has no bearing in reality, Caleb. I mean, I've had cars last 20 years. My dad had a car for 40 years because he was too cheap to buy another one. But so it will last, but the IRS sets up these class lives based on it's actually based on how much income the U.S. government needs to operate and spend their money. And so what they do is they assign class lives to monitor how much depreciation and how much tax deduction an owner, a building owner, it's all assets, but let's just talk about buildings. A building owner can take. And the class lives, remember, if you get nothing out of this, remember one thing: the shorter the class life, the more depreciation you can take. The more depreciation you can take, the less income you have, less taxes. So the shorter the class life, less taxes you pay. So you've got your car, the IRS says, okay, take that $50,000 car and depreciate over 5 years. Okay, good. That's easy. You take 50,000, divide it by 5, and $10,000 is the amount of tax deduction you get off of your income. Great. You buy office furniture. It's 7 years. But a building, and I ask this question all the time to my clients, who are trying to understand depreciation. How long do you think the class life is for a building? And they think, well, a roof will probably last 10 or 15 years, maybe electrical 15 years, plumbing, maybe 10, bathroom, but no, it's not that. If you own a commercial building like a strip center, let's say, the IRS says you have to depreciate that over almost 40 years. 40 years. So you spend $1 million and, you have to spread that $1 million over 40 years. You're getting roughly $22,000 in tax deduction on $1 million purchase. And then I ask, and then I will always get asked, well, are you telling me that the IRS says bathrooms and kitchens and carpeting are going to last 40 years? It's like, no, they can be depreciated over 5 years. Then wait a minute. You're telling me, so you have a building that has to be depreciated over 40 years, but there's parts and pieces of it that can be depreciated over 5 years? How's that work? I mean, that doesn't make any sense. No, it doesn't make any sense. We're talking about the IRS here. You're trying to, find rational sense in the IRS. good luck. So you have all these components within the building that can be depreciated over a shorter class life. Let's just say you have, I don't know, $5,000 worth of carpeting. And now that's in that building. You purchase the building for $1 million. That carpeting is in there and being depreciated over 39 years. Even though the IRS says, well, the carpeting can be depreciated over 5. So what cost segregation is it's an engineering firm that comes in and puts a value on every single component inside the building and assigns a different class life to it, a shorter class life. And remember, the shorter the class life, the less taxes you pay. So that's what we do. And then, like everything on the outside, and as you have your driveway or your fence, or maybe you've got a security system. Well, that's not going to last 40 years. The IRS says, no, that can be depreciated over 15 years. It's like, so you have this dichotomy. You've got the CPA depreciating a building over 40 years, but it's made up of a bunch of stuff that can be depreciated over 5 and 15. And that's what cost segregation is. And we change a portion of the depreciation so more can be taken now and less can be taken, 10 or 15 years down the road. But the key is the time value of money is taking that additional depreciation and having it and paying less taxes. And instead of paying the IRS, you take that money and you give it to Caleb and let him find you another property, something like that. So it's a real strategy to build your portfolio by taking it. And then cost segregation is 100% IRS approved.
A couple of questions. When you say building, what are the qualifications of a building? Because you have multiple investors out there. You've got, people that own multiple single families. You've got duplexes, tris, quads, and then beyond. What classifies as a building as far as what this falls under?
Yeah, I mean, the IRS has a very definitive definition of what a building is. It's got 4 walls, a roof, etc. But for what we're talking about here, a building is anything that you own that you do not live in as a primary residence. Anything. It could be a VRBO, Airbnb, could be multifamily, could be the Empire State Building.
This is going to be very valuable I hope everybody out there is listening up, because this is a way to kind of make the most out of what you are working with when it comes to investing. What was I going to ask you? So 1031 exchanges, does this apply? How does this all work when it comes to that? Is there any, when people are looking to take tax money from here, put it into here, can that be applied with the savings, take the money out of here and put it in another investment property so that you're not taxed on it? Or how does that work?
Yeah. The combination of cost segregation and 1031s are, that combination is incredible. So typically, when you do a cost segregation on a building, you're gonna separate the building into different class lives. 5 years, everything on the inside; 15s, everything on the outside, and 39 or 27.5, if somebody lives there, is going to be, is going to have to stay where it is, because it's structural. Anything structural, like a roof or a foundation, has to stay in the longest possible class life. There's nothing we can do. The 1031s are great because you can do a cost segregation on a building and then get the tax benefit. And then, and again, I stress, it's not a strategy for taking the money and buying a boat or sticking it in a mattress somewhere. The idea is to put it to work. So you have a building, you do a cost segregation on it, and then somebody offers you a whole bunch of money, but you don't want to pay the long-term capital gain, so you find another property to buy, and as long as you fit the criteria, the long-term capital gain is deferred. You're going to pick it up sometime, but not now. So what you can do is you can take those 1031 proceeds into a new building and cost segregate the new building also. Now there's some tax things, and I'm being overly simplistic, and we'll get into 1031's exchange on another interview, because they're really fascinating. But you can do a cost seg on the old building, you can do a cost seg on the new building.
This is ringing true for a lot of people out there, because a lot of people want to get in the investment. I think people have come to an understanding, and this is what I say about investing in real estate, regardless of how big or small. They're not printing any more of it. It's a pretty darn sure thing. And like one of my other investors has told me, where can you see an 8% gain with paid? He's showed me a stock that shows 8% gains and pays dividends throughout the life of it, and you can sell. So I'm a believer in land. So is this legal?
Yeah, it is. It's 100% legal, and it's not even in a gray area, Caleb. And it's not, me creatively interpreting U.S. tax code. I'm not that smart, but it is absolutely there in black and white. It's about 25 years old. And these being able to depreciate, and I'm from Jersey, so you're going to see me talking with my hands a lot. But anyway, you're going to see, in the U.S. tax code, it's very clear. So 25 years ago, the cost segregation really came to fruition on a very large court case that the IRS took a very large, I think it was Hospital Corporation of America. Hospital Corporation of America, I don't even know if they're still around, but they owe the IRS $1 billion with a B. And they said, well, you know what? What if we took all this medical stuff and the bathrooms and kitchens and security systems, and we depreciated those over their correct class life? And the IRS said no, and the HCA said yes. Well, let's just see about that. So they went to court. The IRS lost, and the IRS said, okay, we're tired of losing these things. It costs a lot of money, and we hate losing anyway. So we are not going to question any cost segregation studies moving forward. As long as it's done by an engineering firm it's an arm's length transaction, meaning it's a flat fee. And as long as your CPA doesn't get involved, because we don't trust them, and as long as you, Mr. Building Owner, don't get involved, because we sure as heck don't trust you, as long as it's a third-party firm that does the work correctly, leave it alone. And that started an entire industry. I've done probably 10,000 of them, never triggered an audit. Never even had an IRS agent question it, because it's in the tax code.
Interesting. So basically, for all you sports fans out there, it's like you don't want somebody that has gone to an SEC school refereeing the SEC championship. There's going to be some bias. So you mentioned CPAs, and let's say I have a great CPA. Shouldn't they know about this? Why don't they?
Yeah, and that's probably one of the most one of the first questions I ask. Well, I've got a great CPA. I'm sure you do. It's not your CPA's responsibility to save you taxes. And it's like, no, that's not true. That is his responsibility. No, it's not. No, it's not. His responsibility is to do your financials, to do your personal returns, keep you out of trouble, maybe do your payroll. But nowhere does it say, unless you pay for, $500,000 to get your tax return, you use Deloitte or Ernst & Young, and they bring in a tax specialist, for additional fees. Your CPA that you've known since college, and we probably went to an SEC school together, that you continue to use, it's not his job to save you taxes. So he doesn't get paid more. It's illegal for him to get paid more if he saves you taxes. That is literally against the law. So his job is not to save you taxes. His job is to do your taxes, put the numbers in the little boxes on the correct form, put a stamp on the envelope and send it off. That's his job. So a CPA is really not the responsibility to save you taxes. Also, the IRS was very clear in that it's called an AOD, an action on decision. The action from the IRS is, we will not question these. The decision was against the IRS, and the action is, we will not question those. The AOD makes it very clear: a CPA cannot do these calculations. They do not have an engineer on staff. They do not have engineer experience. They have not cost construction experience. They can't do it. So they have to, if they do see, and some CPAs will say, you know, you should do a cost segregation on this. Okay, where do I find that? Let me open up the yellow pages, and I don't see anything under cost segregation. It's like, well, you're on your own. You know, you got to find somebody, or, you know, I have somebody you can use. But yeah, it's kind of when you start doing cost segregation with a CPA, it goes very smoothly, but it delays their tax return because it takes 30 to 60 days, and CPAs want to get these returns out. They want them out quick because you and I, especially me, I give my information to the CPA the day before it's due. So it's like, well, Kevin, you know, we have these tax strategies that maybe we could use, but you didn't give us time. So cost segregation is not your CPA's responsibility. He can't do it himself. And unless he has a relationship with somebody like us, he doesn't want to take a chance of possibly having these calculations be wrong and having an audit and having penalties and interest. So there's a little, CPAs view this as a little bit of risk because they've got to go outside to get it done.
You mentioned returns. Do I have to amend these returns when they come?
No, you don't. And you don't, not only do you don't, there's no amended returns, there's no closed tax years. And this is where we get into the weeds a little bit, Caleb. So what we're doing is called a tax method change. We're changing the way the CPA does one of your tax methods, one of the methods to, you know, calculate your taxes. Maybe there's 15 or 20 methods he uses. We're changing one. But when you change a method of accounting, you just can't stop with the old and start the new, because at some point there's going to be inconsistencies. There's going to be a year where the new and the old mix, and then they don't play well together, and it creates all kinds of problems. So what the IRS says is, look, just take cost segregation the new way, go all the way back in time until you first bought the property and apply it retroactively.
Oh,
and
wow.
it's like, all right, well, you know, boy, you know, how do the calculations work on that? It's actually pretty simple. So you calculate how much income would have been reduced had I used cost segregation from day one until today. Let's say you bought a property in 2010, straight line depreciation. So what we would do is we would go back to 2010 and look at the tax return and say, okay, this is how much you would have saved in 2010, 11, 12, 13, all the way up to 2023. Had you used this new method, you would have paid less taxes. Well, how much? We do the calculations, and then you bring that deduction into the current year. So you add them all up, add all of the reduction in income, the reduction in tax, you add it all up, you bring it into the current year, and you apply it to the current year. It's called and I swear I wouldn't do this, it's called a code section 481A. I told you I wouldn't quote code sections, but I can't. Okay.
Yeah. The code section 4, yeah, no, of course.
481A. It's amazing. It's a phenomenal risk-free way to really maximize your real estate holdings.
Question on, I'm sure everyone thinking about this is this going to trigger an audit? The scary.
Yeah, no, I mean, nobody wants to trigger an audit. You know, the IRS is like a big, you know, orca killer whale. You just want it to swim on by and not even see you. No, it does not, because it's actually in the IRS code now. There's like 30, 40 pages about how to do a cost segregation study correctly. And if you do it correctly and you hire a third-party firm, there's zero chance of an audit. And sometimes, you know, a client will get audited on different things, and then the IRS will say, can I just see your cost segregation study, you know, while I'm here? You have it. It's signed by an engineer. It's done by an engineer. There's like 13 things in the study that have to be complete. So we have all of those covered. Our engineers sign it. My partner's a CPA. He will sign it. The IRS has no leg to stand on. The only thing the IRS could do if they want to refute anything is bring in one of their engineers to refute it. And those engineers are going after Apple computers and Microsoft and Donald Trump. They're not going after an investor in Huntsville, Alabama, or Phoenix, Arizona, because there's not that many of them. Mm-hmm. And even if they did, we use IRS approved software. We follow the regulations. We do all the paperwork. We sign the paperwork. There's nothing there, so they will just leave it alone. Mm-hmm.
So it sounds expensive, but how big does my building have to be? And you've described what a building is for this to make sense financially.
It makes more sense to look at how much income I have. So how much income you have from those rentals.
From the okay.
Yeah. So let's say, we could do a very lucrative cost segregation study on a building that's $100,000. Good luck finding that. That's a doghouse in Huntsville, Alabama now. But we can go that low as long as the client has the income to offset, because the depreciation offsets income. And let's say you have $50,000 of income on your rental properties, and we create $100,000 worth of depreciation. Well, what happens then? We wipe out the 50,000, and then we take the other 50,000 and we apply it to next year and the year after that. And so my question to investors is, some don't have any income. We're just barely breaking even between, cleaning and roof repairs and this. We don't have any income. Don't do it. Don't do cost segregation unless you have income to offset. Wait till you do have income. It's like a get out of jail free card. And I know that's a terrible analogy to use in a tax, in a tax recording, but you can use it whenever you want. Wait until you have enough income that it's starting to hurt. You will always have an alternative to that by changing the way you depreciate your building. So it's more important to know how much income you have, more than how big of a building it is.
Like they say, it's not how much you make, it's how much you keep.
That's exactly right. Exactly right. And my job is to make sure that you keep as much as possible, because our government does such good work with our tax dollars, don't they? I mean, they really do wonderful work. Yeah, yes. Right. Yes. So my job is to make sure that they don't get more money than they absolutely have to get.
You hear that, everyone? This guy's fighting for you. There's a million ways to invest. Will this work on a VRBO or an Airbnb? Is there anything that, this doesn't work on?
No. Airbnb and Verbos are great. I owned a property and went Verbo and, cost segregated it and wiped out an entire year of rental income. No, it will work on every building, depending on the income from the client. Now, there's other things that, and we'll talk about this down the road also, Caleb, is if sometimes, let's say you have a client who works at, I don't know, Boeing. That's a big employer there, and he owns rental real estate. Well, that rental real estate is called passive income. It's income he gets from not really doing anything. So when you do a cost segregation, it will only wipe out the passive income. It will not wipe out his W-2 income from Boeing. However, there are scenarios where if you are called a real estate professional, it will wipe out, the depreciation will wipe out all the passive income and still carry over and now wipe out your W-2 income. And I'm wetting your whistles because this is stuff that is, it's PhD level. It really is. But as an investor and an owner, you have to know this stuff. You cannot rely on somebody else to take care of the biggest expense you're ever going to have, which is taxes. You don't have to walk around reading the tax code, but you do have to have a cursory understanding of it, so you can question your CPA, ask him questions, say, did we do this? Did we do that? and take that responsibility yourself. Don't let somebody else determine how much taxes you pay. It's set in stone already, but at least understand the options that you have, and then get more information from you, from me, whomever, about how to take it that step further.
This is fascinating, and I know it's going to resonate with all those, he who has ears to hear, as I like to. People are going to hear this and want to know more. We've got a couple minutes left. I've got two questions for you. Thank you this is a lot to digest, and I'm looking forward to, learning more about it down the road. Little off topic here, but you've been a successful businessman for a very long time, it seems. What is the best piece of advice that you have been given that you'd like to tell me and whoever watches?
Now I'm stalling for time. You're going to have to tell me more, like best piece of advice about business, about real estate, about taxes, what?
I always say this: the best financial advice my father ever gave me was this. He said, if your outgo exceeds your income, your upkeep will be your downfall.
I love that. That's really good. In fact, I'm going to steal that and pretend I made it up.
Take it.
I guess the most important thing that stuck with me is the richest man is not the man who has the most, but who needs the least.
Amen.
That has always resonated with me.
Amen. Amen. That's incredible. So I'm looking forward to more down the road, but how can people get in touch with you?
You can find us at taxmethodexperts.com. Google Kevin Jerry. I'll come up. Yes, I know I have two first names, and it's a long story. We can talk about it another time. But but Google Kevin Jerry, KevinJery, or Tangible Property Tax Methods, TPTM will come up. My face will come up. My contact info will come up. Please reach out. But also, I do have to say, Caleb, that what you are doing for people right now is they have no idea how valuable it is. They really don't. I think I heard another quote. I think it was Carly Fiorina, the old HP CEO. She said there's two types of taxpayers: informed and uninformed. And informed taxpayers always pay less than uninformed. And so how do you become informed? Well, you go out and buy real estate, make a bunch of mistakes, go to, grad school and suffer through 16 courses and $50,000, or listen to these recordings. What you're doing for people is incredible. Everybody should be at least sending Caleb a Christmas card this year, because what he's giving you, you have no idea how valuable it is. And as we go into subsequent recordings, it'll start clicking. And if you take what you've learned and just take that next step, pick up the phone, send an email, send a text, just do that one small next step. The momentum of this will create a tax situation that will blow your mind.
Too kind. I almost want to make that the intro of the of this video. Kevin, it's a pleasure. I thank you very much for your time, and I have a feeling that people are going to be much better off from just listening to this few minutes of you explaining what you have a deep understanding of, that was, like I said, is going to extend down the road. Thank you so much. I look forward to the future recordings and everything, and meetings, and yeah, thanks for your time. I appreciate you.
No, thanks for having me. I love talking about this stuff. I could talk all day. So, thanks for for allowing me to have, terrible jokes and just be myself. So thank you, Caleb.
All right. Well, thanks everybody. Talk to you soon.
Okay. Bye.